This isn't your average business podcast, and he's not your average host. This is the James Altucher Show.
Just to mention, we were talking about the law of max screwing,
Yes.
which we just defined here. So there's Murphy's Law, and now we'll call it James Omid J's Law, which is that if you could ask the question, like, I hope I'm not paying for X, then the answer is always, yes, you are in some way, because you're always being screwed in the maximum possible way you could imagine. So if you have to ask the question, then yes, you're being screwed. And the reason this came up is, Jay, you don't pay for electric vehicle charging in your building. And Omid asked, well, I hope I'm not paying for it. And the default answer is, yes, you're paying for it, even though we have no idea how you could possibly be paying for it. And then Jay, you brought up a real example. Oh, yeah, Omid asked you if you are getting the subsidy on your vehicle, and you said no, they ran out. And of course, because you're screwed somehow.
Of course,
So-
yeah. And then when the new bill got introduced, I wasn't in that time frame because that new bill start next year.
Yeah,
Oh, so
you got
people who buy
max screwed.
People who buy a Tesla next year are going to get the rebate that you did not. Oh yeah, that's max screwed right there.
Exactly. I was like in the limbo that I didn't. If I bought it like maybe 4 or 5 months earlier, I would get it. Or if I bought it maybe 4 or 5 months later, I would get it. So.
But by the way,
Yeah.
they're going to be max screwed if they buy a Tesla next year, because A, prices are going up because he had to use so much of Tesla money and resources to buy Twitter, and B, electricity prices are going to go up because all the gas in the U.S. was used up until the election, and gas prices are going to go up next year. So
There you go.
Everybody's getting screwed. But let's see if the law of max screwing applies to crypto. Omid Malekan, author of the only crypto book I have sitting on my bookshelf right now, Re-Architecting Trust, The Curse of History, and the Crypto Cure for Money, Markets, and Platforms by Omid Malekan. Omid, despite the title, I hope this book is selling really great.
The book is not selling great, and I was wondering if you would bring up the title again. So,
Well, it reminds people of the title, Re-Architecting
Yes.
Trust. I still think the Crypto Cure, or the Curse of History and the Crypto Cure, that's an exciting kind of title. It's a curse and it's a cure.
It's got alliteration is my favorite literary technique, as anybody who reads the book will be able to tell. So,
Look, Tim Ferriss, the 4-Hour Work Week, Tools of Titans. He uses alliteration. What's another one? I don't know another one off the top of my head.
if people start looking for it, it's actually everywhere. And
World of Warcraft for games.
There you go. League of Legends for games.
Right.
A favorite game of.
Here's one
I
that's
was gonna
not. Oh, go ahead.
No, even cryptocurrency, right? That works.
Yeah, I'm looking at a book right now on my bookshelf, The Stress of Chess, which is not alliteration. I think that's consonants when it's the last syllable where the consonants are the same.
Oh, interesting. And that's also a form of rhyming.
Yeah.
Huh?
So let me see. I'm going to look at other books here. Not this is so critical to what we're going to talk about. No, I can't. I don't see any others. The Age of AI by Eric Schmidt and Henry Kissinger.
That is a strange combination of authors if I ever heard one.
Yeah, and the third author on that is this guy, Daniel Huttenlocker, who was a professor of mine like 35 years ago. So it's just an odd coincidence. He's the AI guy. But, Omid, thank you so much for coming on the show. We've had many conversations off the show, but you have so much knowledge to share. Formerly involved with Citigroup and all things crypto. Now on your own doing all sorts of stuff. We've obviously, FTX was this huge scandal in the crypto space. People are saying it's the largest, corporate fraud in history, larger than Enron. I've actually already done a podcast on that. So we don't have to go over every detail of FTX, but are people going to lose faith in crypto with the fact that you can't trust where you put your money necessarily?
In the short term, some people are, but most important thing to remember is that at the end of the day, a technology is either useful at solving problems or it's not. And what happens with various individuals or corporations who at some point are prominent in doing something with that technology, in the long run becomes irrelevant in the conversation. So, for example, you and I are old enough to remember that after the dot-com bust, there were some various busts and also frauds. WorldCom at the time, I think, was the biggest corporate scandal in U.S. history. But and there were probably skeptics back then who thought, oh, this whole like information revolution and the internet and e-commerce and the importance of telcos, that was all hype. Like the internet doesn't actually solve any real problems, blah, blah, blah. Now, when we look back, that all seems kind of funny. And in fact, most people probably don't even remember what happened with WorldCom. And in the aftermath of this FTX blow up, I touched up on some of my own history, including some of the stuff I talk about in the book. And it's interesting that there's almost a likelihood that anytime you have some kind of a transformative technology hit the scene, that there's a lot of chaos in the beginning, and also that there's some kind of a catastrophic scandal. So this was true in the early days of the oil industry. It was true in the early days of the railroad industry. I talked about the internet example. And ironically, even central banking itself, one of the anecdotes I discuss in the book is what happened in France hundreds of years ago. One of the first experiments with the current model of central banking, where the central bank just issues paper money. And it ended catastrophically in ways that ended up sowing the seeds to what would eventually become the French Revolution. But I'll bring all this up because at the end of the day, we have trains, we have oil, we have the internet, we have central banks, because what mattered in the long run wasn't whichever the early adopters were and whatever the scandal was. What mattered in the long run was, did the technology, be it physical or social, solve important problems? And I think the case for crypto doing that is as strong as ever.
And I'll get to what problems crypto solves in a second, but you're so right. And even more recent examples, and by recent, I mean in the past, let's say 50 years, you have the savings. Financial innovation is a tricky one because the problems it solves only appears after that initial mass speculation happens and that first fraud happens. So you have, for instance, junk bonds was an incredible financial innovation, where a young student of Wharton named Michael Milken wrote a thesis that said basically bonds that were rated around C or B minus, which is considered junk, they were called junk bonds, they were considered so bad, actually repaid more often than people expected, that you could make a lot of money investing in junk bonds. But then there became a junk bond bubble created by then banker Michael Milken that people took advantage of, and there was lots of fraud, and he ended up going to jail for a while. And then there was the savings and loan industry just a few years after that, where I don't even know all the details of that. But of course, you had the internet, you had Enron, which was trading in natural gas derivatives, you had Lehman Brothers, which was dealing in the highly unregulated space of derivatives on derivatives on derivatives in the housing industry. You had Bernie Madoff, of course. And now we have this FTX, which, by the way, it's not like this was a 150-year-old U.S. bank, highly regulated. This was something started 3 years ago by essentially a guy living in the Bahamas. It's completely unregulated. It's less regulated than the average hedge fund in the U.S. is. And something like this was bound to happen, although it's unfortunate that it did.
It's unfortunate that it did. And there are aspects of the FTX story that are still shocking, even to me. The biggest one being that one is that all these supposedly very sophisticated investors, including Sequoia and the Singaporean Sovereign Wealth Fund, invested vast sums of money into this company at very high valuations. And while they claim to have done significant due diligence, I can't see how that's possible. I mean, even today, the the person who's taken over now to lead the bankruptcy process, I forget his name, but he's done this for Enron and other collapsed
Yeah, I want to say
companies.
John Arnold, something like that.
Possibly.
Yeah.
But then in the report, the initial report that he put out, he said that this was like the messiest company he's ever seen, far worse than Enron or anything like it.
And he was the one, led Enron in bankruptcy, meaning when Enron went bankrupt and the fraud was revealed, he was the one to take over Enron and unwind it.
Yeah. And I just, as someone who's worked with venture investors, I don't know how how a company could be this disorganized and messy, never mind fraudulent, which it turned out to be. But you would think all of these investors, particularly because this is a very lightly regulated company that was based in the Bahamas, it's a new company, it's run by a bunch of young people who are very inexperienced at running companies. You would think that their due diligence, if they actually did what they did, would have brought up a series of important red flags.
I wonder if early on those red flags existed. So, I mean, a lot of the problems stemmed in recent days from the fact that they had a $10 billion margin call, and Sam Bankman-Fried, SBF as he's called, he moved $10 billion worth of FTX client assets over to this hedge fund, which is totally, illegal. But that was only the most recent part. I don't know, maybe there wasn't anything illegal, 3 years ago when he was getting investment, or 2 years ago.
Well, some of these were earlier this year. So it was recent enough. And even what you alluded to, that for people like me, I never expected it to be this scale of a fraud. But
yeah,
the fact that you have one of the biggest exchanges basically co-own one of the biggest hedge funds is completely unacceptable. And this is one of those things where the crypto industry would be served well to learn the lessons of history from traditional finance. And one of those lessons is that it's very important to have separation of responsibilities. So if you go into the Wall Street structure, you have exchanges, but then you also have custodians, and you have brokers, and you have clearing houses. And by design, there's a lot of separation between them, some of which was even tightened further after Madoff, because the idea is that they serve as sort of checks and balances on each other, and that you eliminate potential conflicts of interest. And one of the interesting things with SBF and FTX that makes this story very Madoff-like, I think you've talked about this repeatedly on your podcast, that one of the reasons Madoff got to be so big was because his investors thought that he was doing something shady, but they didn't think he was running a Ponzi scheme. They thought he was front-running his market-making business.
Right. So they already were kind of winking at each other. Hey, this is probably illegal, but we're not involved, so we're going to make a lot of money from it. We're on the same side as Madoff. And I suspect Alameda, customers or investors, or even FTX investors who were staking, probably thought, yeah, he's probably doing something shady, but at least we're benefiting from it.
That's right. So I am guessing one of the reasons people were willing to look the other way of the shoddy stuff is they thought, oh yeah, well, he's got this hedge fund, and it's got this exchange, and they might be ripping off the exchange's clients, but that's just good for the exchange's business.
Yeah. And so that's probably why they invested. They probably did not think it could go under in any way. And this is the mistake people repeatedly make. Like, even you were referring to the early experiments in the central bank with John Law and how he would print money. The people early on, or the people who were closest to him, probably figured, hey, this is a Ponzi scheme, but at least we're at the top.
Yeah, and one of the consequences of John Law's initial efforts was the Mississippi bubble, which was literally making everybody rich. So that is, I think, another takeaway from what happened here is that crypto has these severe boom-bust cycles, and we're now coming off yet another bubble phase. And during that bubble phase, a lot of people sort of suspend skepticism and disbelief. And particularly from institutions, I'm fascinated by this idea that a lot of the capital in crypto is biased, by which I mean, here you have these massive institutions investing lots of money in a unregulated corporation that was founded 3 years ago because it does stuff with crypto, but they would never own Bitcoin.
Yeah.
And I think that there are legitimate reasons for why a pension fund or a sovereign wealth fund might not own Bitcoin. The regulatory questions, the infrastructure in terms of things like custody might not be enough. But I've always thought it was funny. Like I meet people even over the summer who would tell me, I want to invest in crypto startups. What should I invest in? And I would say, well, Bitcoin's at like 20,000. You should just, if you want exposure to the cryptocurrency industry, you can now get the blue chip crypto that's made it this far at less than 50% what it was a year ago. Why would you want to buy some startup that'll probably fail just to get tangential exposure to it? And I think that restriction that was self-imposed on pension funds and institutions led them to make some dumb and risky decisions, not just with FTX, but with some of the other crypto corporations that have blown up in the last 3-4 months, like Celsius.
Well, you make an interesting point. And by the way, now I'm going to mention your title, but in a positive way. Title of your book is Re-Architecting Trust. And that's really what's the difference between FTX and the crypto industry. So the whole idea of Bitcoin, as you explained to me on a different podcast, a month or so ago here, the whole idea of crypto is to be trustless, that there's no human you need to trust. It's an algorithm that everyone could see, basically. Like, notice there's been no fraud with any of the decentralized finance exchanges that are built on top of blockchain because it's all algorithmic. We can see every transaction, essentially. We know what's allowed and what's not because it's just right there written in the code. So certainly the largest DeFi exchanges, the main players have gone through the code and it's fine, or else these wouldn't be large exchanges now. And FTX was run by this kid who was making decisions. You couldn't trust him. It's the whole point of crypto is not to have to trust some kid to make valuable decisions on your money.
Indeed. And to me, one of the other takeaways from this latest period is that the technology worked surprisingly well, I would say, because it's been stress tested because of the severe volatility that we've had. We've also had, because of the fallout from what happened with FTX, various other kinds of exchanges and lenders have liquidity issues, potentially even insolvency issues. But the major blockchains, Bitcoin, Ethereum, etc., they worked fine. The decentralized finance applications that you were referring to, they worked fine. So hopefully this is going to be a wake-up call for everyone from individual users to even the big institutions that play in this world, that it's time to double down on the actual decentralized corners of the industry that are trustless and resilient and a lot less likely to turn out to be a massive fraud than FTX, which at the end of the day was just a corporation like any other.
Although I would say also, like, let's take Coinbase as a great example of a centralized exchange, not decentralized. I would say that's most likely, as trustworthy as any other brokerage firm in the US, because it's in the US, it's regulated, it's a public company, so it's heavily audited, probably more extensively audited than most because of the crypto aspect. Nobody's taking chances. And if you're a public company in the US and you're the CEO and the CFO, you could go to jail if you lie, even a tiny lie on a financial statement. You're going to jail because of laws enacted after Enron and WorldCom. So I do think exchanges like Coinbase, maybe CoinList, and a few others are safe because they're in the US, but this one was not. And I will add also, crypto is obviously a $1.5 trillion industry, maybe larger now, and FTX had 16 billion in assets. So it was a very small part of the industry, 1% of the industry. But still, it scares people. They don't know what to do. All the people who kept saying crypto is a fad, it's not going to exist, just like in the internet days. Now they're saying, I told you so. Just like from 2000 to 2002, all those internet naysayers were saying, I told you so. And then they shut up after that. But what happens next? And what would be a catalyst that would get, right now, Bitcoin and Ethereum have been in a range, like Ethereum's been between 1,200 and 1,300. Maybe Bitcoin's been between 15 and 18,000. Since this FTX stuff, what happens next?
I think I'll set aside the macro considerations of what the Fed's going to do and all that, because far be it from me to be able to predict that. But I think the next big thing is going to be utility and adoption of everything from Bitcoin to Ethereum to some of these DeFi protocols to even things like NFTs for applications that go beyond just the needs of crypto speculators.
Yeah.
Because one of the critiques against the industry is that it is very internal looking, that people come up with solutions just to make it easier for someone to trade cryptocurrencies, and new currencies are for projects that give you leverage on other currencies, which is true. I don't think that's a bad thing, because I think first you have to really build out the core infrastructure before you can start migrating other economic activities onto it. But the good news is, unlike, say, the last bear market 4 years ago, I think the infrastructure has come along significantly. I think there are a lot more smart, capable people in the industry now. I think we've done a better job of figuring out what works and what doesn't work. So what I'm excited to see now is things like stablecoins being adopted for payments that have nothing to do with people buying or selling Bitcoin, or NFTs being adopted for applications that go beyond people just speculating on a work of art. Could literally be anything. I think the last time we were on here, we talked about tickets.
Yeah.
That's one example, but it could be an NFT is just a good way to assign property rights to any kind of intangible asset. So if you go down the list, and there's studies that show that increasingly the world's assets are intangible assets. So if we go back 100 years, most of the world's assets were real assets. So you're talking about things like real estate, gold, physical commodities, etc. But now, if you go and look at even a company like Disney, it has parks and physical assets, but I would imagine it's intangible assets, like the brands it has for things like Marvel, the movies that it has put out, the characters, etc., are many times more valuable than things like its parks. And this is true almost universally as the economy digitizes now, that the most valuable things, intellectual property, royalty rights, they're all intangible. And before crypto, you had to sort of surrender control to some kind of a centralized institution, but now you can turn all of those things into an NFT and put them on the blockchain.
Yeah, an NFT, or you can tokenize them. So for instance, take the Marvel example. I could, if I'm Disney, I don't have to sell any shares or give up any equity or do some weird thing like spin the Avengers off into a company and IPO that. I could say, look, we're going to take 10% of the Avengers' future cash flows, whether it's movies, toys, comics, whatever, books. We're going to take 10% of the Avengers' future cash flows for the next 10 years, and we're going to turn them into 1 million tokens. And if you buy one token, you have 1/1,000,000th of 10% of all the cash flows from the Avengers for the next 10 years. And here's the thing. Here's what's beautiful about crypto. As you've mentioned before on this podcast, that's a smart contract. So you don't need a whole layer of, lawyers and escrows and accountants to figure it all out. It just, everything goes into a black box on the blockchain and then gets distributed pro rata automatically by just the rules of crypto and how the smart contract is structured. And second, then this is even more a bigger thing in my eye, is there this concept of an internet of value. Like, once I have that token, and I've never been able to do this before, I could now sell that for another token. Like, let's say, Omid, you were tokenizing 10% of your house, and I could trade my token of Avengers for a token on Omid's house on a DeFi exchange 24 hours a day, 7 days a week. Suddenly, everything that's intangible can actually have a value and be traded for anything else that has value, which will lead to its own ups and downs, pros and cons, but it will make the world so much more, it'll make the economy so much bigger and so much more innovative. We've never even seen the likes of it.
Agreed. Because what we're doing now is we are first introducing far more trustworthy property rights to items that otherwise don't have any. That's the first step of tokenization. And then the second part of what you were alluding to is another blockchain concept, which is this idea of composability. Now, let's say Disney issues that token that you mentioned on a popular chain like Ethereum. Now that same asset could be used by other projects, other protocols, other innovators to, one, come up with new solutions for them. So maybe somebody figures out that there is a way, if you package the Disney token with some other tokens, you can give people unique experiences, or even like you could continue to sort of securitize or tokenize them further into things like derivatives. And two, the pace of innovation that you alluded to now goes parabolic, because there are probably a lot of people out there today that have great ideas on what they could do with everything from some claim on Marvel movies, like what you alluded to is just a claim on cash flows. But it could also have other kinds of participation rights. Like maybe if you own those tokens, you get to be the first to get some physical merch or digital merch. Or maybe if you have enough of those tokens, you get to go and attend the screening party or something like that.
Right, and to your point is, it doesn't have to be Marvel coming up with these other solutions. I could, like, let's say Marvel issues that. I can now make a line of Avengers merchandise or some other merchandise and say, hey, I will sell this merchandise only in exchange for Avengers tokens.
Yeah, so the sky's the limit. And actually, we don't even have to talk about hypothetical examples, because Starbucks is coming up with new kinds of tokens and NFTs and rewards on a blockchain, on Polygon, which is a Ethereum compatible blockchain. And it's interesting, actually, one of the assignments I give to my students is to, like, let's brainstorm what one can do with this. And one example that comes up is that there are millions of Starbucks customers all over the world, and now they're going to get some kind of a reward token or coupon or something in their wallet. This now happens on a public blockchain, which means that if you and I were to say we started a cookie company and we wanted to get the word out on our cookie company, one of the things we could do is we can go on Polygon and we could airdrop a token that represents a 50% off coupon to our cookies. And we airdrop them to the most avid Starbucks customers. So now we've achieved two things. One, you and I have managed to tap it.
Can I ask you what you mean? Like, so if I have Starbucks tokens, for instance, they can specifically advertise, hey, anybody with Starbucks tokens, we're going to give you for free these cookie tokens, which have an actual monetary value because they represent a discount, a 50% discount to the price of a cookie. So you can even figure out, like, if you're buying them cheap or expensive.
Yeah, and mind you, we can do all this without any involvement from Starbucks. But here, what we've done now is that this is a win-win-win idea, because the Starbucks customers benefit because now they're getting discounts on cookies. You and I benefit because we get to tap into the network effects of people who like Starbucks coffee. And then Starbucks benefits because it can now say, hey, how great is it that if you're just by virtue of being my customer and getting my loyalty tokens, you're now getting all sorts of other perks. This, by the way, is something that companies do all the time, right? Co-branding, co-marketing. Like, if you fly this airline, you get a discount at this hotel, is a simple example of it. However, traditionally, because of the inefficiency of the infrastructure, to build something like that probably takes like several years of business development teams working together and having to figuring out what databases or systems to use to integrate these things so you can measure like who has how many airline miles and who's staying at what hotel. Once you start moving these assets on chain, all it takes is like a couple of lines of smart contract code, and then you can build on top of previous solutions very efficiently.
Right, like, and you bring up an interesting point. Like, one criticism of crypto is people say, well, what you just described, I could build just using the normal internet. So you just basically started to answer that, but, what if that question was specifically put to you? Well, I could take my cookie coupons and advertise to Starbucks customers, hey, bring in your Starbucks reward card and I'll give you, some cookie coupons. Like, that could be done,
That
like
would
you
be,
say.
It could be done, but it would just be like very inefficient and full of friction. It's also what you just described is permission. We would have to first go and get Starbucks blessing to do this. Now, I have to admit there is a downside to the openness of composability that I described earlier. There might be, maybe somebody wants to airdrop a gun token or something to Starbucks customers, and Starbucks wouldn't want that. So it'll be interesting to see. But nobody has to use it, right? Nobody has to do anything. I actually like all of the blockchain wallets that I have. There's constantly junk tokens that other people send into them. I don't even look at them. Like, I don't care what they are. But there's something about the openness, the interoperability, and the composability of having all the stores of value in one place in a way that anybody can write lines of code that makes them interact with each other, that I think is going to unleash the kind of innovation that we saw in the early days of the web. Like when we were going from that web 1.0 to web 2.0 period where, the initial model was like, well, we'll send email. That's just electronic mail. And then you used to work at HBO and they're like, well, we'll have a website. And the New York Times prints articles. Now they'll put them on a website. But then after a while, people said, wait a minute, we now have this unified global infrastructure for moving around bits of data. What brand new things could we invent that couldn't exist otherwise? And then people came up with things like social media, for example. With blockchain and crypto, we're going to see the equivalent innovation, but as applied to stores of value and things that benefit from having property rights.
Yeah, so it's interesting because, again, using the cookie Starbucks example, if they wanted to do it, make some sort of alliance there, they'd have to build their own private infrastructure for doing it. If I wanted to take an application, or if I was an airline and I wanted to make an exchange for frequent flyer miles, and I got all the airlines to agree, that exchange would only work for frequent flyer miles. If I now wanted to add Starbucks cards, that's a whole other thing I'd have to write. Whereas the infrastructure for this is already built. So with the internet, and the internet's a good example. Even before the internet, I could log onto a network with my modem and go to the New York Times network and see kind of what we would call now a website through a private, the modem would dial up a phone number. It would interact with a New York Times computer. You'd have to probably download some interface and you would see, oh, here's the articles on the New York Times. If they wanted to do it that way. In fact, there was FTP, File Transfer Protocol, before there was HTTP, which could be roughly equivalent to that. But what the internet did was it made it so that you didn't have to build a network between two entities for this to happen. The internet was a public internet protocol, IP, that, it was TCP IP. So public internet protocol where any computer and information on any computer can communicate with any information on any other computer. And it's the same thing happening here. Instead of everybody building billions of applications to, have anything of value be traded for anything else of value, that infrastructure's already been built and people have been working on it for 13 years. Although I would say that particular use case still hasn't even started yet.
Not fully, but the nice thing about this being late 2022, as opposed to when we might have had a similar conversation 4 years ago in the last bear market, is that stuff is happening. Starbucks is doing rewards on the blockchain. Disney is actually, there's something new that they announced that I haven't even had a chance to look into because of all the FTX related drama. But there are many large players that have now committed significant resources to deploying things on the blockchain. And the nice thing about that is that when we hear from the usual suspects, like I saw once again this week, Nouriel Roubini is predicting that blockchain is useless and it doesn't solve any problems. Exactly what he was saying 4 years ago. In fact, I looked it up. October of 2018, he testified in front of Congress claiming as such. But whereas 4 years ago, people like me were mostly talking about theoretical applications that other people could deploy. those things are happening now. So I actually know very little about the coffee industry or engaging with coffee consumers, but Starbucks knows a lot. And the fact that they have this serious project that they probably be working on for years and are going live with it tells me that there's something there. Same thing for Disney. Same thing for Nike. Same thing for all of the different auction houses and galleries in the art market that have engaged with NFTs. Same thing with all the fashion brands that are doing things with NFTs. Like, I don't know that much about high fashion, but I trust that Gucci does. And Gucci has gone as far as purchasing tokens that make it a member to a decentralized curation project, just so it can have some say on the kind of high-end fashion and art items that get sold there. So stuff is happening. And what I'm looking forward to is once the news of FTX and prices falling and people losing money starts to fade into the background, then it should be easier for everybody to spot the adoption and innovation that's actually happening.
Yeah, and I wonder, one thing I was going to add, though, to the tokenization of things. Remember, like 20 years ago, David Bowie took his catalog, songs like Space Odyssey and Ziggy Stardust and all these things, and he borrowed, I think it was about $700 million off of the, and it was going to be the interest rate that the lenders would get would be based on how well those albums did over the next 10, 20 years. And people who invested in those, they're now across the industry called Bowie bonds, and his was the first one. They made a significant amount of money, like more than, I think, definitely more than interest rate returns were returning then, and probably more than stock market returns. But people like you and me couldn't get Bowie bonds. Like, you had to call a bond broker who knew about those bonds, who could then get access to them. And there was no market to trade them. Like, you wouldn't be able to buy them after they initially sold. And that's almost like a relic. Like, that's an antique way of thinking. Like, with it's already, the technology's already here, where if David Bowie wanted to do this now, he would simply tokenize. I mean, he's dead, but if someone like David Bowie wanted to do this now, he could tokenize in the same way. And now anybody could buy them at any point. And then it'd be a market to trade them. It'd be Uniswap or Sushi Swap or Pancake Swap or whatever. But the one thing I always think is, and this is, again, like the early days of not only the internet, but anything, it's hard to do this. Like the average person is not going to suddenly say, oh, I'm going to sell Exxon on the New York Stock Exchange through my Fidelity account, and I'm going to buy some weird altcoin on Sushi Swap, and I'm going to figure out my MetaMask wallet and what I should do with my private key. I'm going to have a seed phrase for my private key, and then maybe I'm going to get a safety deposit box for my cold storage wallet. Like, it's too complicated right now for the average person.
The frictions are very high. And one of the nice things that's coming out of the FTX debacle is because many institutions had kept their assets on FTX. Some of them were basically using it for custody or storage. And on the one hand, it's easy to criticize them, say, hey, the whole appeal of crypto is this idea of self-custody, right? Unlike the stocks that are in your brokerage account, you could have custody your own coins in your own kind of cold storage or something, or your wallet. You chose not to. And probably a lot more people will going forward in general than before. However, I think one of the reasons crypto VCs and other kinds of crypto savvy people decided to keep assets on an exchange is for all the reasons that you said. The frictions of self-custody are extremely high. And I think there are two paths forward from here, and they're both going to happen. One is that the industry is doubling down on ways to make key management and self-custody a lot easier, with ideas like there's something called account abstraction, or even a simpler one that the audience could relate to, social backups. As you alluded to, right now, if you self-custody, you initialize a wallet, you have a seed phrase that really represents the right to own those assets, and you have to go back it up somewhere. You can't just have it on like one computer or device, because that could crash, it could get stolen. With social backups, the idea is when you create a new wallet, you will no longer have to do the seed phrase, put in a safe deposit box. You just appoint 5 people as your family or your group or whatever you want to call it. And then the technology will enable that if something goes wrong with your assets, like you lose your wallet, then you'll just be able to request them to confirm that you're you and not some kind of a hacker or phisher. And then you will be given control of your assets again. Maybe if like 3 out of the 5, click something inside their wallet. And in its early days, the final products will probably be more streamlined than that. So I think that's one path forward, just better, easier ways for everyone from individuals to large institutions to self-custody their assets. But the second thing is, I think we're always going to need centralized participants in the ecosystem, like exchanges, like wallet providers, like brokerages. If nothing else, we're decades away from the point where everything is tokenized and everything is on chain. So we're going to need institutions to serve as the bridge. And that is one reason, one of the main reasons people use exchanges like FTX is like, hey, I have dollars in my bank account. I understand once I own the crypto that I can use DeFi and store the coins myself, but how do I get there? Well, I have to deposit my dollars at an exchange, and exchanges are bridges between the traditional financial system and the blockchain. So the second parallel development is going to be, how do we get better exchanges and custodians? Better in terms of more responsible, and then better in terms of more regulated. However, and this is the kind of a dangerous inflection point for crypto, more regulated does not mean let's take the existing regulations that were written for the New York Stock Exchange 75 years ago and force Coinbase to follow them as well. And there are definitely people in government, like the current head of the Securities and Exchange Commission, who would like to see that happen. But that to me is a little bit like saying, hey, we have this new thing called YouTube. It has channels. In the old days, if you wanted to start a TV channel, you had to go get an FCC license. So let's have every person that wants to have their own YouTube channel go apply for a federal license from the US government. Right? It just sounds obnoxious and ridiculous. So if we're lucky, we'll get smart regulations that take into account the fact that the world has changed in the last 70 years. And that also there are features of blockchain and crypto technology that in some ways actually makes it easier to regulate exchanges.
Yeah. So when do you think that will happen? I mean, I think it'll probably happen. On the one hand, I think it will happen faster because of this FTX thing. On the other hand, the people who were starting to introduce legislation in Congress and the Senate were backed by Sam Bankman-Fried in their latest elections. So they might be a little more nervous now.
Some of them, although the interesting thing was that just like several weeks ago, Sam Bankman-Fried floated the regulatory model that him and his money were trying to ram through Congress. And it was not good. It was more along the lines of, let's take the old regulations and throw them at the new tech. Like one of the ridiculous proposals was that any website that lets people interact with DeFi should have to go get a broker-dealer license. Like that's just
my gosh,
absurd claim. But it would have benefited his exchange because they already had the licenses, and it would have hurt DeFi. I would like to think that this is a moment for government officials to get together and be like, okay, the world now agrees crypto needs to be regulated. What are the smart regulations that we can come up with that doesn't strangle innovation and embraces the unique things of the technology and the unique benefits? I hope that happens. Unfortunately, there's always the risk that the opposite happens and that this leads to draconian regulations, at least here in the US, that really just don't help anybody except the incumbents that would like to see this crypto thing go away.
So what do you think, based on all the people you talk to, what do you think will happen next? And obviously we all want to see crypto go up. I think FTX put things a little bit on pause. It might be a day, a month, a year. We don't know. It could be, I think it's just as likely to be a day as it is to be a month as to be a year. We just don't know. But what do you think is next? What could be a catalyst, a real catalyst that could end this 1 year long crypto winter and move things significantly upwards again.
If we get the positive kind of regulation, I think that would really be a boost to the industry. Because I imagine, regardless of FTX, there's a lot of people and capital that's been waiting on the sidelines to see which direction this regulatory thing breaks in, right? You know, the internet is famous for the fact that the US government decided early on to just kind of let it be and took this first do no harm kind of approach. So, and there's still people to this day in the US government apparatus that advocate for that approach. If we get that, I think that's going to be a positive catalyst. I think data that shows actual adoption of the kind I talked to earlier, that would be a big thing. And it means different things for different protocols or projects. So for Bitcoin, couple of things percolating on the mining side that are interesting, like also lost in the FTX news, is that Exxon and Shell are increasingly taking a look at Bitcoin mining as something that they could get involved with. There are people like me who actually think in the long run, energy companies will be the only crypto miners because it helps smooth that.
They get electricity for free by doing, like, let's say, carbon capture on their drilling.
Yeah, and even if you want to like build out a new solar or wind farm, it actually, if you install mining alongside it, you have a way to monetize when you have excess energy production, like it's really sunny out, but there's not demand for air conditioning because it's winter or something. And that will make you willing to spend more money into it. So I think announcements like that, where we see these large established companies get involved in a way that really ultimately, like, they wouldn't do this if they didn't think Bitcoin was going to go to zero. So it would improve the value proposition. I think within a year or two, we're going to start seeing Bitcoin get adopted at the state level. And I'm talking about central banks and sovereign wealth funds start playing with it.
But don't you think they're waiting for regulation to occur?
Not necessarily, because that story is a geopolitical story and a de-dollarization story. And hey, we just saw both Russia and Afghanistan get its dollar reserves basically be confiscated by the US government. That calls into question the reliability of the US dollar as a global reserve currency. But there is no other option that's necessarily better. And I'm by no means arguing that like everyone's going to just suddenly like switch all their dollar reserves to Bitcoin. But when people talk about Bitcoin as a store of value, the one thing they leave out is that it's a store of value that comes with its own censorship-resistant payment system. And that's never existed before, right? Even neutral.
What do you mean by censorship-resistant?
Nobody can prevent anybody from having a Bitcoin wallet and sending coins to anybody else. And that's true enough for a bar of gold. It's just that it's literally impossible for me to send a bar of gold from here to Australia if I had reason to. It would be very, very risky and expensive to do it. That's one of the reasons we don't use gold for things like cross-border settlement. Nobody wants money that's harder to transport than the good or service that you're using it to pay for. So Bitcoin has these gold-like properties in that it's neutral. A government cannot just print a lot of it. If you have Bitcoin, nobody can prevent you from spending it, just like if you had a bar of gold and you wanted to give it to somebody else. Other than physical coercion, which is hard, nobody can prevent you from spending it. So I think this idea that we now have credibly neutral money solves a major problem the world has, which is that it increasingly does not trust the United States to be the steward of neutral money, partly because of the inflation that the Fed keeps creating, and partly from the fact that we've continuously weaponized access to the dollar as a foreign policy tool. So the alternative to me eventually will be Bitcoin. Again, I'm not saying everybody's going to put all their money in Bitcoin. There are many reasons why I don't think Bitcoin will ever get that level of adoption. But I think Bitcoin makes a lot of sense as a sort of like a break glass in case of emergency money. That governments, corporations, even individuals, you'll keep like 2-5% of your savings in Bitcoin. because you never know when you're in a pinch and whatever other money you are using is no longer available to you. Bitcoin will always be available because the network is decentralized.
Yeah, and then I guess and then look at Ethereum. So whereas Bitcoin is the flight to safety, perhaps for countries and sovereign wealth funds, as opposed to the dollar, Ethereum is kind of like the programming language to make it all happen. And Ethereum is deflationary right now. There's less Ethereum right now than there was last week, and there will be less Ethereum a week from now than there is right now, probably. So eventually, if supply is going down, whenever demand kicks in again, and demand comes not just from speculators, but from people building things who are using Ethereum, which is different than stocks, which is just about investing, Ethereum price could go. That's why I think Ethereum is much higher off of its lows than Bitcoin right now.
In the short term, the prices are driven by all the mechanisms you mentioned. But then Ethereum is down more than Bitcoin in the last few weeks, but it went up more over the summer because of the excitement over the merge. But in the long term, I would not be surprised if Ethereum ends up becoming in aggregate far more valuable than Bitcoin, just because in markets in general, productive assets tend to have significantly higher value ascribed to them than non-productive assets. So, it's like all the dollars in the world are worth, it's like 22 trillion or something. All the gold is worth 12 trillion, but then all the equities are like 150 trillion. And I think all the real estate is even more valuable than that. And Ethereum is unique from Bitcoin in that not only could it be something that you use as a store of value and its own kind of neutral money, but it also becomes what you pay to access credibly neutral settlement of anything. So any kind of transaction or activity where you have two parties who may not otherwise trust each other, but want to have a transaction where they can both be assured that the outcome is what they expect it to be, you can build on Ethereum. And you could you have dollars on Ethereum, and you have other kinds of cryptocurrencies on Ethereum, and art.
And this is why a lot of DeFi exchanges are built on top of Ethereum.
Yeah, and the irony here is that while crypto, particularly among the skeptics, has this reputation as being something that's risky from a purely finance 101 point of view, an infrastructure like Ethereum will de-risk the rest of the global economy significantly, because all financial infrastructure ultimately exists so you and I can trade something, right? Or there's transaction, there's payments, there is loans, but there are actually very little guarantees that anything will happen. What we end up doing is saying like, well, we want to make sure that, let's say we're doing a foreign exchange transaction, right? I'm going to send you dollars, you're going to send me euros. The dollars move here in this US-centric infrastructure, the euros are in this other infrastructure, and in between are banks and payment providers that facilitate the trade. The way we make sure stuff happens as we expected now is like we regulate the hell out of the banks and payment providers, which has a lot of downsides. One is that it gives them competitive moats. It enables them to charge fees. A lot of people don't get to access the banks and payment providers. When we move into a world where we put digital dollars or a dollar stablecoin and digital euros and a euro stablecoin on Ethereum, which is already happening, now you can just use this cheap, transparent, universal infrastructure called DeFi. And you and I could now trade dollars for euros in a way where, first of all, we have more predictable outcomes than we do if we go through a bank. Second of all, it's more universally accessible. Anybody can use Ethereum. Not many people around the world, for various reasons, can't use a bank. And then third of all, it's cheaper. So cheaper and safer for a fundamental transaction that happens today, which is foreign exchange. But we can also do the same thing for people that are buying goods and services, or people that are trading stocks and bonds. So this idea of an omni-asset platform that is providing us with assurances. I mean, it's what we call trustless, meaning we don't have to trust each other. We can just trust the outcome. That's the kind of thing that's going to just de-risk all sorts of financial and non-financial activity.
Yeah, I totally agree. I mean, I think the whole point in this FTX thing is ironic in that this is almost a proof, you know, a good anecdotal example of why we need crypto is because FTX was not really about crypto. It was just a corrupt offline exchange of assets. I mean, Sam Bankman-Fried even said he doesn't care if it's crypto or orange juice. Like, he would trade it through FTX. But of course, it's being associated correctly. So it's being associated with crypto, but it's kind of against the point of crypto. And that's, you know, that's why the DeFi exchanges haven't blown up in fraud, because you can't have a fraud on them. But, you know, I shouldn't say can't ever, but presumably, again, just like people know the code inside and out of Bitcoin, the top developers, a lot of people are familiar with the open source code of Uniswap and PancakeSwap, and they would see if there was potential for fraud in the algorithm because it's all publicly available. But so the final thing people are talking about is, what's the contagion? I hear this from everywhere. There's contagion. There's contagion. This FTX is going to bring down governments. It's going to bring down. I've heard it's going to bring down the Ukraine. Like, what's the contagion issue here?
There's minimal contagion within crypto. There is contagion within this tiny industry comparatively that is crypto, and we're already seeing it, that there have been some other lenders and stuff who've lost assets. The impact on the rest of the economy is virtually zero. And I have found it hilarious, just like in the past week or 10 days since this broke, this obsession from everyone from like pundits on CNBC to government officials to try to make the argument that this could be a systemic effect for the rest of the financial system. Just to put some numbers on it, all of the crypto in the world combined right now is worth about 800 billion. All of the world stock markets are worth 140 trillion. And then the bond markets, I'm guessing, are even bigger. So this idea that a financial asset that represents less than 1% of global value, because it's fallen 20, 30% in the last month, could lead to cascading failures among financial institutions, the vast majority of which, mind you, have nothing to do with crypto, right? Like the world's biggest banks, pension funds, hedge funds, the vast majority have zero exposure to crypto right now.
I agree. And not only that, the vast majority of crypto has little exposure to FTX. FTX represented 1 or 2% of the crypto. There's no one crypto exchange that is more than 1 or 2% of crypto. You know, even the biggest DeFi exchanges are like 1/10 of 1% of crypto. But what about contagion in terms of other things? Like, you know, you mentioned Sequoia and SoftBank. Will venture capitalists be less reluctant to invest in crypto-related projects? Will institutions be less reluctant to invest? Could the contagion spread that way?
It could, but I actually think it's probably a good thing that venture capital is having this gut check moment, because I've seen a lot of things in crypto in the past year with VC that just didn't make sense to me, both in terms of absurd valuations and in terms of people forgetting what this technology enables in the first place. So when I say something like Ethereum is credibly neutral, or when we say these protocols are censorship resistant, one of the benefits of that is anybody can innovate and build on top of that. That's a benefit because a lot of the existing moats that exist in traditional finance do not exist in crypto. So a simple example.
You and I can't go out and start a bank tomorrow.
Yeah.
Or an insurance company.
Right. But if we wanted to, we could write code that represents smart contracts that will be a DeFi protocol. But even for things that are not purely decentralized, like everyone's probably heard of OpenSea. It's the #1 NFT trading platform. And at one point last year was making a lot of money off of fees. So the VCs went and funded like 150 different OpenSea competitors. You know, like there was the Tom Brady backed one, and there was one for games and one for and I was just sitting there the whole time and being like, the blockchain offers no moats. So what value prop does the 150th NFT platform have that?
Well, there's always a brand moat if they can build a brand. So if they can build a brand that's bigger than OpenSea, for instance, that's a moat.
Okay, so maybe one of the 150 does it. But the beauty of the crypto is that the assets are free to move. So, and this has already happened. I have friends that they used to trade their NFTs on OpenSea. And then other ones popped up. So then with one click, you can, I'm going to list my asset on OpenSea. No, I'll list it on the other one. You can even, like, there are ways to list them on multiple ones, and whichever one gets you the best price, you take it there. And I'm just using this as an example that I think VCs got a little bit carried away. The whole metaverse thing and virtual worlds and all of that. I think that's way too early. Blockchain gaming is a very interesting category, except like the hardest thing to do in the world is to make a fun game. So
this has been my problem with the metaverse. Like, I'm not like, who wants to play in the sandbox or Decentraland? Like, just the name Decentraland makes me think of 1994 internet. Like, why don't you join our cyber game? Like, and games, like you said, they've spent decades building the infrastructure of Take-Two Interactive Games or Electronic Arts Games. I think Microsoft is far smarter than Facebook in terms of the metaverse, because they just simply bought Take-Two Interactive. And when the time's right, they'll take those games and they'll throw NFT assets in it and crypto tokens in it and so on. And then suddenly you have a metaverse.
Yeah, I agree. I think like the V1, I had this debate with a friend of mine who's a veteran of the gaming industry and now has his own startup. And 3-4 years ago, I was like, what do you think about blockchain for games? And he said, well, why would I want that? I said, well, people now purchase a lot of virtual items in games, right? You have games like Fortnite that are actually entirely funded by people buying virtual items, but they have very little property rights, right? Like, what if that company goes out of business, or what if they get censored out of it for some reason? If you put those items as NFTs on a blockchain, then your users have more assurances that they will own those assets forever, which, by the way, in any market, property rights make people more willing to spend money on it. And he's like, okay, that sounds good, but is it going to be fun? I was like, what do you mean? He's like, the number one rule for video games is not will the in-game potion or hat have property rights. The number one is it's got to be fun. You can give up people all the property rights in the world. If it's a fun game, no one will ever play. If it's not a fun game. But if it's a fun game, people don't care about most other things. So I think that's a great point and a great challenge. And it remains to be seen what it takes to build blockchain games that are fun. But all these VCs that just threw like millions and millions of dollars of anyone who showed up that said, I'm going to build a game that's on the blockchain. And I have no experience in gaming or blockchain. A little bit more skepticism and discipline from the VC industry, I actually think will be a good thing.
I agree with that. I think it got a little out of control, just like in 1999, how VC money into internet companies got out of control. And hopefully it'll temper that, and hopefully it'll be faster. The comeback, I don't think it's going to be 3 years for a comeback, but my guess is after this. I mean, the other thing is FTX is kind of the biggest, you can't imagine a bigger scandal in crypto because there's not really anything bigger than FTX in terms of crypto. I mean, there's Coinbase and Binance.
Right.
But what other crypto projects even are bigger than how big FTX is? They're not, we're talking tens of billions. Most, crypto projects are in the tens of millions, and not even most. I'd say the biggest crypto projects are really in the tens of millions. This happened to be exceptionally big. It was almost an outlier. It's so big.
Indeed. And I actually think, I'm going to go out on a limb here. I think soon enough, there will be scandals that come from traditional markets that will make everybody forget about FTX. And not that I wish scandals on anyone, but the amount of schadenfreude that those of us in the crypto industry have experienced from Wall Street people, government people, regulator people who are like, see, I told you that this whole crypto thing was bad and a scam and would never work. We already have very efficient markets for bonds and stocks. But James, you and I have been around a long time. We are now experiencing the end to one of the longest bull markets in history in bonds, right? It's like goes back 40 years. And the way it's ending with these rapid Fed hikes, there are scandals coming. That there are Ponzi schemes and people who've done crazy things with T-bills and bonds that no one can even imagine.
But that might get scary, like if PIMCO or something like that, it becomes a Ponzi scheme. It would just be, or Berkshire Hathaway is a Ponzi scheme all of a sudden.
I'm not going to name names because I don't know who, but your history of markets, has there ever been a very, very long bull market that didn't end without some shocking frauds or Ponzi's coming to light?
I would say there's no market that ever began or ended with Ponzi schemes on both sides. I mean, and when we were doing the hedge fund, that was kind of the tail end of hedge funds 1.0. And now when I look back on it, almost every single hedge fund, knock on wood, or thankfully, except for ours, had aspects that remind me of FTX and Enron. So like, you know, an ability to mark assets wherever the heck you wanted instead of actually, you know, marking them at a conservative value. Like we saw that in the pipe industry all the time. And we saw other things where people would take illiquid markets, you know, make one trade and then mark to market their assets according to that one trade. And boom, they had high returns for investors. Then they raise money, they'd mark off the loss because now they're so much bigger and the loss is insignificant compared to what it was when it was a gain. And on and on and on. Like we saw so many things that were Enron-like, i.e., you know, also FTX-like. It's just ridiculous now when I look back on it, like how scary that industry was. But now it's evolved. Now hedge funds are essentially banks. Like, you know, you have, you know, Jim Simon's Renaissance Technologies. No one would say that's a scam, even though it has the qualities of a lot of these scams. They're trading in ways that nobody understands and they refuse to explain the algorithm. and that's just like Enron. And it's not regulated. It's a hedge fund. So no one could go in and look at the books. It's, you know, it has high trust. It has a high trust factor because Jim Simons is like a Nobel Prize level mathematician, just like Bernie Madoff was like started the NASDAQ and Ken Lay was friends with, you know, President Bush and, you know,
And
so
the
it has
long-term capital guys had Nobel Prizes.
had Nobel Prize, right?
Yeah.
Yeah, that's right. I forgot about them.
Yeah.
And so like Renaissance is almost all the aspects of an Enron, but I know it's not a scam because hedge funds now it's like an institutional industry now.
So I don't know who, I don't know where, I don't know when, other than probably like in the next 6 months, but I am confident that an FTX type thing will happen. In fact, what is it? It's mid-November. I'd love to come back in 6 months and you can hold me to this and we'll
Right.
see if I was right or not. It's just history repeats itself. Human nature does not change. Not only do we have this like multi-decade bull market in multiple markets that are coming to an end, but the other thing that's happened is like the few times where small things could have come to light, like in 2020, for example, central banks and governments just stepped in and bailed everybody out, which means like there might have been small frauds and small Ponzi's that 2 years ago might have been that big, but then trillions of dollars and euros and yen in money printing turns to bury a lot of sins. But now with everything happening with the macro environment, the energy crisis, the interest rates going up, something bad's going to happen. And again, I don't wish this on anybody. I'm just a student of history. So there is that saying that like, what is it? Those who live in glass houses should not throw stones. So I will say those who live in fragile traditional markets, most of which were architected 50 to 150 years ago, should not blame crypto because bad things are coming your way too.
I mean, we know this too from the Great Recession, 2002. Every bank is essentially a scam. And the only reason the Great Recession stopped, and this is really the topic for another podcast, is that for a while they changed the law so that banks have to accurately mark their assets at their real value. It used to be, you know, marked to imagination. Like banks had to give a best estimate and we had to trust the banks to value their own assets correctly, which is ludicrous. And the only way the Great Recession ended was because Congress said, oh my gosh, we give up. Like, or not the Congress, CFTC or, you know, whatever regulatory agency does. They were finally like, okay, all right, you guys win. Go back to the old way of just marking things however you want. And from then on, the stock market started moving up and never went down again. So it's the FASB 157.
And then since then we've had I lose count, right? Like I remember even before COVID in 2018, like the Fed was raising interest rates and then they abruptly stopped and started cutting interest rates, even though like the stock market was at an all-time high and the Unemployment numbers were at an all-time low. There was something about like market problems happening. But one of the nice things about crypto, despite, people hear about the negative headlines and the crises and the chaos, but one of the nice things is we get the bad stuff out of the way quickly. We let the bad companies fail. We don't bail them out. We realize
That's a good point.
who the disingenuous people. I mean, this is one of the reasons why it's so volatile, because we just let everything play out in real time, and it's scary. Like, this is a scary moment in the industry. I have friends who've lost their jobs. I know other people who are worried about, are their coins safe wherever they happen to be, and so on. But we are clearing out the dead wood, to use a natural example. But what's happened in traditional markets for decades is that every one of those small brush fires that would have cleared out the dead leaves and twigs and whatnot have been doused by a fire hose of central bank liquidity, which, as anybody who knows about forest fires will tell you, all that does is set you up for the big one.
Yeah, I mean, look, I hope there isn't a big one, and I hope things go back to, honestly, if I'm really being honest, I kind of hope the Federal Reserve just goes back to bailing everyone out all the time. Because that's when the markets go up, everyone makes a lot of money. Sure, some people are making money unfairly because they're getting the bailout and they're stealing it and whatever, but that's the Fed's fault, not my problem. And I like it when the stocks go up, and markets go up best when the Fed is throwing money at the economy.
But that's
and
also,
not just the Fed, Congress as well.
But that also leads to inflation.
Yeah, I don't care. I'd rather have inflation than deflation. I'd rather see assets. I'd rather see assets inflating, because then the stock market inflates.
It's an interesting point. I don't know
if the only reason the stock market's going down now is not because of inflation, but because they're worried the Fed will tighten so much that there will be deflation. Inflation's only bad really when either there's hyperinflation or inflation's only affecting a small part of the economy and not wage inflation. So
that's interesting. I actually wonder this about crypto, because when I was writing the book, right, and I was studying the history of money and whatnot, there are all these people that have this false sense of history when it comes to think like gold and hard money, which is by nature fairly deflationary most of the time. One of the reasons you don't want deflationary money is that it just wreaks havoc with the rest of the economy. Like, if your money is going to appreciate in value, you don't want to spend it, you don't want to do anything, you don't even want to invest it, right? You're like, my money's becoming more valuable every day. Why would I go start a company? Right. And then you also, when you have any kind of hard money or fixed supply money, what ends up happening is during a boom, you have all this borrowing and lending that synthetically increases the money supply. And then during the bust, you have a bunch of lenders blow up and the money supply contracts. So money goes from being very inflationary to very deflationary. And by the way, this is what's happening in crypto now. Right? We had all these crypto lenders, Bitcoin lenders that popped up in the last couple of years. Price of Bitcoin went on and up and up. It was inflationary for the rest of the crypto space because the price of all the other coins were going up. The price of NFTs were going up. Now all the lenders blew up and the Bitcoin money supply is collapsing. So the value of everything else is coming down. So this interesting question, I don't have an answer to it, actually. Even Ethereum, right? You mentioned that Ethereum now might be deflationary because of this burn mechanism they introduced.
Right.
I'm not sure that's a good thing in the long run, because I think like ETH is something you want people to spend, right? You want them to spend ETH on DeFi and transaction fees and NFTs. But if it's deflationary, people are going to want to hoard it.
Yeah, that's true. We'll see. Then again, though, what's different about ETH is that you need to buy ETH if you want to use it to build a project. Like, there's other things than speculation involved.
Yeah.
So, just like a home, I like it when the value of my home goes up because I'm not spending my home, I'm living in it.
Right.
But it's nice to know that it's the worth of it is going up. And I would argue, going back through the history of money, so deflation we know is bad. Deflation occurred in 1933, the beginning of the Great Depression. It occurred in 2009 during the Great Recession, and it occurred in March 2020 during when the pandemic started. Deflation's always been bad, and hyperinflation we know is bad. Germany, Rwanda, Russia, so on. But when has just inflation been bad? Now, there will be months and years where it's bad, where, let's say, oil's going up and something else is going up, but wages aren't yet going up. So when there's pockets of inflation that are much greater than other pockets of inflation in the economy, that's bad. It has to smooth out. But when has inflation been in general bad over a long period of time? Like gold bugs, like people who are bullish on gold will say, oh, well, the US dollar has lost 97% of its value since 1903. Yeah. And we also have now telephones on every house and airplanes and rocket ships and computers and the internet and painkillers for when you get your root canals that never used to. Like the highest cause of suicide in the 1800s was dental pain. Now, because of inflation, no more dental pain. So inflation's not necessarily a bad thing. I don't know any time in history when inflation's really caused the downfall of a society as opposed to hyperinflation or deflation.
That might very well be true because there's also a generational component to this. If money isn't at least a little bit inflationary, then it ultimately means that older generations are increasingly better off than younger generations because they already have them.
Create revolution.
Yeah, because if older people have the money and it only goes up in value, then it's harder and harder for younger people to get any. So there are very interesting dynamics here to which I don't necessarily have the answer. I don't know if anybody's smart enough to have the answer, but I think we can all agree, like you said, that the extremes are bad.
Yeah. Well, Omid, once again, author of Re-Architecting Trust, probably the smartest book on crypto I've ever read. The subtitle is The Curse of History and the Crypto Cure for Money, Markets, and Platforms. Omid Malekan, Malekan. Let me say that again, Malekan. You can follow you at Malekan Ohms, Malekan OMS, on Twitter. Everybody should do that. Thanks once again, Omid, for coming on the podcast. Always a pleasure. People should go back and listen to all our episodes, our Wall Street Insane episodes, because they were insane. And thanks again.
Thanks for having me, James.